Hello everybody. In this lecture, we will look at the meaning of shares and share capital. We will ask what the three classes of shares are. We will see why shares are important by looking at the various voting rights that one incurs. And then we will focus on the solvency and liquidity test, ask when such a test should be done, and then ask the question around the liabilities of directors. So in this lecture, we will explain the meaning of share and share capital, discuss the types of shares that are commonly found in the corporate world, list the various rights attached to the different types of shares, discuss the solvency and liquidity test with specific reference to the meaning of the test, the application of this test, and the potential liability of directors if the requirements of the solvency and liquidity test was not met. So what is a share and what is the share capital? Well, members contribute an amount of money to the share capital, and this share capital becomes the property of the company. So for the amount of money that you contribute to the company, and this money then becoming the property of the company, the shareholders in return get shares. So members contribute money to the share capital, and then the unit of contribution will be indicative of the kind of share that the shareholder will now receive. So the more money you contribute towards the share capital, which belongs to the company, the more shares you will get in return. So because the money belongs now to the property, the share capital is the property of the company, the shareholders will get certain rights against the company. And I think you have all heard of companies declaring dividends. That is when the company makes money and can in return give some money back according to the shares that a specific shareholder holds. So how do you prove that you have shares in a company? You get a share certificate, or you get a recording of the securities account of the depository institution acting on behalf of a company. And in easy terms or layman terms, that just means you get a bank statement of the kind of securities that has been deposited into the bank on the behalf of the company. It is very important to note that already in the Memorandum of Incorporation, the authorized share capital must be stated, and we will explain an authorized share capital in a moment, as well as the classes and numbers of shares that may be issued. We see that the board of directors may subsequently amend the number and classes of shares, but in the Memorandum of Incorporation, the authorized share capital must be stated, as well as the classes and numbers of shares. So what are authorized shares? We see that when a company is formed, the founders will decide on an initial numbers of shares, and these shares are called authorized shares. And they are really the tradable shares. So they will indicate what the value of the company is. And how does that work? Well, the share price is multiplied by the number of shares issued. And that gives you the value of the company. Sometimes there are also unauthorized shares, and this is when the founders decide not to issue all the shares. So to keep some of the shares back, to reserve them for later use. And these kind of shares can be traded for money. So in other words, sold to the market or into the market for money, or they can be traded instead of money. So they can use shares to buy things instead of money. So shares instead of money. So what are the classes of shares that must be included in the Memorandum of Incorporation? Firstly, why is it important to have classes of shares? Because this will influence the voting rights of the shareholders. So there are three classes of shares, namely the classes of share to information, a share in the profits declared as dividends, and then the right to participate in the distribution on liquidation. What are the classes of shares? There are preferential shares or preference shares, ordinary shares, as well as deferred shares. Can a company buy back its own shares? A company can, and often a company will do so to increase the value of the remaining shares in a market. Let's look at an example. A company has 70 issued shares trading at 100 Rand each. So the company value is the 70 times 100, which gives you 7,000. So then the company buys back 20 shares, and then only 50 issued shares are left. But the company is still worth 7,000, and of the 50 shares left, their value has now increased to 140. So the company's value still remains at 7,000, but the value of the shares have increased. So what is the solvency and liquidity test? The solvency and liquidity test in a nutshell is used when, according to Section 4 of the Companies Act, directors of companies want to embark on certain actions or enter into specific kinds of transactions. Then they must do a solvency and liquidity test. Why? To avoid a company trading recklessly in insolvent circumstances. So what is the liquidity and solvency test? It means that the company must be liquid. So in other words, it must be able to pay its debts as they become due in the normal course of trading for a period of 12 months after the test. And the company must be solvent. And solvency relates to the assets of the company, fairly valued, being equal or exceeding the liabilities of the company. So what impact does it have on the directors if they do not do the solvency and liquidity test before embarking on Section 22 actions? Well, we see that Section 77 states that the director of the company is liable for any loss, damage, or costs sustained by the company as a direct or indirect consequences of the director having carried on the company business despite knowing that it was conducted in a manner that was reckless, negligent, or to defraud any person. Or if the director was a party to an act or omission by the company, despite knowing that the act or omission was calculated to defraud a creditor, an employee, or a shareholder. Or if a director signed, consented to, or authorized the publication of any financial statements that were false or misleading in a material respect. So what does it mean when we say reckless business? When a company carry on reckless business with gross negligence? Well, reckless business or business in a reckless manner refers to a situation where a company continues to incur debts, where in the opinion of a reasonable business person standing in the shoes of a company would not have continued with such debts or with such actions. So in this lecture, we will explain the meaning of share and share capital, discuss the types of shares that are commonly found in the corporate world, list the various rights attached to the different types of shares, Discuss the solvency and liquidity test with specific reference to the meaning of the test, the application of this test, and the potential liability of directors if the requirements of the solvency and liquidity test was not met.